So hi everyone, welcome to the first episode of Market Chats, and if you have a better name, please let me know. I'm always looking for suggestions. Ben, if you've got any suggestions, let me know. But today I'm happy to say that we have Ben from patternprofits.com here with us on the first episode, which is great to have. And Ben is one of my favorite follows on Twitter. I always get new ideas from all of his different scans. So Ben, thank you so much for being here and welcome to the channel.
Thank you, Richard. I appreciate the kind words.
Yep.
Very nice of you.
Yep. And today I want to focus on a couple different things. First, I want to ask you a bit about your background as a trader, your best trade, worst trade potentially, the books that helped you along the way. And then I want to talk a little bit about your trading process. And finally, since you post such great scans on Twitter, a little bit about your process with using MarketSmith and how you develop those. So to start off, how did you get interested in trading?
So initially, back in college, we had a fantastic market there in the late 90s, and my roommate was heavily involved, and I had no exposure, to the markets at that time, really no experience at all, and he was just doing well, making money, daily, weekly. We talk about it, and I said, I want to get involved in this. What do we need to do? And at that time, you actually had to call your broker and, put in a bid for whatever it was you were looking at. And so I basically just got into just kind of sharing the account with him. That was the first way, my first exposure. And it was his lead as far as the ideas and all that. I didn't even know where they were coming from. I just know we were making money every week. I was happy. Then things kind of turned, especially into 2000. The market turned, and things got a little bit more complicated there. You couldn't just buy anything and watch your money grow. So at that point, we gave a lot of money back, a real lot of money back. I'd like to have even half of that back at this point. But that's when I really got the bug and said, okay, I need to really come up with a way that I can get ideas on my own, not relying on someone else. And that's where I went straight to the books. Said, okay, this is where I'm going to learn. And really the first book that was an eye-opener for me was William O'Neill's How to Make Money in Stocks.
Great. How did you come across that?
So, I think at that time, it was just go to the bookstore, kind of look around in there and talk to a couple other people and said, this is the way I think you should look at the market as a whole. It's a good big picture of how the markets work. And to be honest, I think actually the very first time through that, I didn't get any of it. I didn't know. I didn't really understand it. Earnings and these patterns and stuff. Every time I read it after that, I took something new from it. And probably even to this day, reading it for probably the 20th time or more, I can still go through it and take something new from it. And there's just not many. And at this point, I've read a lot of them. A lot of books, and there's just not many that stand the test of time and are still, providing new valuable information 20 plus reads later. For sure.
So do you find yourself looking for new books or kind of going back to the same ones like William O'Neill's?
A little bit of both.
A little bit of both. Okay.
Yeah. This past year, and I read this one a couple times too, the life cycle trade, to give me more exposure to IPOs. I thought that was a fantastic, more modern version of what we see in William O'Neill's How to Make Money in Stocks. Same patterns, different names. They gave them. We have a whole new vocabulary now with that book. But I think it's a modern take on the same principles and just applying it specifically to IPOs. But yeah, I'm constantly reading. Now those ideas come from Twitter, and we see this book was fantastic and getting great reviews, and we have a better process now for finding, which books are really, really helpful, in finding those next big growth winners. Because, that's the whole point of it, for me anyway, is, I want a repeatable process to find those big growth winners. So any new material that comes out, I'm interested.
For sure. I was really surprised how helpful Twitter was, because you've got great traders willing to share their experiences, like Mike Webster, yourself, a lot of the other people from IBD, Mark Minervini. So I was really glad to find that community and be exposed to people who are willing to share charts, their experiences. I was really surprised that people are willing to share so much on Twitter, and you yourself share great scans, all the charts that you're looking at. So I really appreciate it a lot. Apart from Bill's book and The Life Cycle Trade, what other books do you think are must-reads for new traders?
Stan Weinstein's book, How to Make Money, Bull and Bear Markets. That's another one that you can, kind of build off that foundation. A little more, longer term trading, investing ideas. But again, a good, big global picture of how the market works, and just like maybe a slightly different view of it. But the concepts, are very similar. Murphy's book on technical analysis.
I haven't heard that one.
Another one that had a big influence, because you don't hear or see many people talk about the cycles of the market and those waves. And boy, that one covers, you name it, from Fibonacci. And I mean, it covers everything. So that was another big one. I recommend that one to come later on. You want a good base, and foundation to build on before diving deep, into that that type of technical analysis, especially because it's very detailed. So if that's the first one you go to, you're liable to say,
be confused.
Yeah, I'm not even going to attempt to do this. This is, just way too much for me. But if you have a foundation that you can build on, I think that's, another fantastic one. I think Mark Douglas, Trading in the Zone, another big one. Psychologically, how to, approach the markets, stay in the zone. That's tough for a lot of traders, especially in the beginning. You have a little bit of success, the ego gets big, and quickly the market brings you back down to earth when you give it all back, and then some.
For sure.
So that was a big one that helped quite a bit with staying focused, and when you're running hot, trying to, stay in that zone.
For sure. I really like Stan's book, because at the very beginning, he kind of understands that you don't yet know the language of trading, and he kind of builds it up as it goes along. So I really appreciate that with Stan Weinstein's book. So we're in a nice bull market at the moment. We've been going strong since mid-October. Where do you think we go from here?
So I think there is a very good chance we're going higher, probably at least into the election. This is kind of as good as it gets scenario with low rates, and the growth is there. Jobs, unemployment numbers are great, and the Fed is still wind in the sails, with the Fed. So we don't see that environment, at least, over my trading career, we haven't seen that kind of Goldilocks environment for higher prices. And I don't think the Fed is going to let the market come in much before we go to polls in November. So I think higher from here, it seems crazy given how far we've come in a short period of time. But I definitely think, it's where we're headed, at least in through November. I'm a little worried about if we keep up at this pace, what happens on the other side of that.
For sure.
But for now, we'll enjoy it and stay in the zone.
Yep, and hopefully make money and keep it when it turns. So how does this compare to the 90s bull market?
We're not there. The euphoria that we saw in the late 90s was incredible. I mean, we're seeing a few stocks, Tesla, Space. We're seeing, a few select names that are making those parabolic moves. But imagine, groups of stocks, all of software, all of, any thing that has AI or
blockchain, IoT.
Yeah, imagine all of them acting like Tesla in space. That's kind of what we were in there. I mean, everything was going up 20-30% or more a day. I mean, it was.
That's hard to imagine.
Yes, you may get a taste of it though. I mean, we're getting more and more of that. Even the market read today, stuff still, just ignoring, those headline numbers, and you can see signs that it's possible that we kind of go parabolic here, but hasn't happened yet. We still, and there's probably, if I had to guess, a good 3 or 4 months before we get to that kind of really euphoric stage. But be ready, because you never know, and it could happen anytime.
For sure. So what kind of market indicators do you look at? Do you use some key moving averages that you like to see the QQQ or the SPY stay above?
So I do, and I use both a shorter term, which I kind of share on the blog at patternprofits.net. I'll look at a 65 period moving average, which is the same as the 5-day moving average on a 30-minute chart. So that gives me kind of and I just look at the major averages, the SPY, the IWM, QQQ, just to kind of see what the major averages are doing. I try, and especially lately, I've tried not to let that influence, what I'm doing in the big picture with my positions. With those positions, I'm more likely to, especially if I have a profit cushion, I'm looking to ride that weekly 10 MA as long as it'll let me. Volume looks good. I've got cushion, prices, going in the right direction. I'm a big fan. I know that that's a big area of institutional support. So the way it works for me is to kind of have in the back of my mind what's happening in general, in the short term. Do I need to put on some hedges if I'm really, really, being aggressive with my portfolio? Or am I okay to just kind of ride through it, let my positions work, and manage them, individually? But big picture, that weekly 10 MA, that's the moving average that I focus on the most.
Great. So how soon do you switch over to that weekly chart after kind of making your initial purchase? Or do you use it from the very get-go?
No, not typically. I'm on the daily chart at the beginning, looking for breakouts there, pocket pivots, trend line breaks. That's usually where I'm looking to get into my positions through the daily chart. As soon as I have some cushion, give me 10% plus cushion on the daily chart, and get my cost basis to where I'm below the weekly 10 MA. That's when I'm going to switch to the weekly chart. As soon as I can get that cost basis, the sooner the better, which is a lot of times some of my best trades I'm buying at the weekly 10 or the 50-day moving average on the daily chart, because rather quickly, if I make a little progress, that my cost basis is below that, and I can switch to the weekly chart.
Great.
And that's ideally what I want to do, is get to that weekly chart, as soon as possible.
Cut out that noise from that daily chart, because that's definitely messed me up a couple times. You see a stock dropping, and by the end of the week, it's recovered all the way, and even more. So how many positions at a time are usually focused on?
That's kind of changed for me recently. Initially, I would stay in the 4 to 5 range, but as
very concentrated.
Yeah, very concentrated. I didn't generate as many ideas going back several years ago as I do now as well. I have kind of this regular feed of ideas now based on the screens that I've built. So there's a lot more opportunities presented than before. So that gets me more into the 8 to 10 range as far as positions, and I'm still not as comfortable with 8 to 10 positions as I used to be with between 4 and 6, let's say.
Interesting.
I feel like with the smaller positions, I get more of a feel for how they're trading, what's normal, what isn't. When you start getting into 8 and 10 positions, it gets a little tougher to kind of feel. We always say it's more art, than exact science. And a lot of times it is my gut telling me, something doesn't right here, before I get the signal that's confirmation that says to get out. Yep, it definitely isn't right. So that's harder the more positions you have on.
For sure. And that just, I guess, is something that you kind of learn with experience, and build up that instinct.
For sure. Exactly. It comes with time, just screen time, being in the market. You'll find that on Twitter too, you'll see I'm in and out of the same stocks a lot of time.
I remember you battling with SE over and over again. It was getting to that breakout point and then got knocked down. But if you stay with those stocks, it's the fifth time that maybe it's going to work. So
there's a love-hate relationship with several of those stocks, over the years. But I do feel like you know those stocks better. You know the action. You know your stock much better when you've been in and out of it for 3 years than a newer stock that you've only been in for a few weeks. You kind of know what's normal action, what the volume should look like, what news you can ignore, and what news you want to perk up to and pay attention to. I think that only comes with experience and screen time.
For sure. So after you've read the life cycle trade, do you find yourself focusing a little bit more on the IPOs?
I mean, I think that's a natural thing right after you read it. You're excited about it. You're encouraged by this new information. I definitely, it also helps that we're in a good market
for sure.
them. They've been performing, fantastic. I think your attention kind of goes there. And I mean, I don't completely get away from my bread and butter, type trades, but I would definitely say over the last year I've experienced, quite a few more hits and misses in the IPO market than probably over the last 10 years combined. So that's a lot of in and out of those IPOs. But they when you're right and you get them right and the timing's right, you're rewarded immediately. And when you're wrong, you better get out quickly because
cut your losses.
They're a very volatile instrument.
For sure. So in order to determine the market direction, do you take anything into account like sentiment surveys or put call ratios? Do you use anything like that?
That's a good question, for sure. The sentiment indicators I've always used, it seems like from the very beginning, even going back to Bill's book and when I was an IBD, subscriber. And I do watch that put call ratio. I watch it daily. It's a lot better indicator for bottoms than tops because I've had what I would consider my, topping signal since November, and we're still grinding higher. But for bottoms, when you start to see the sentiment gets really negative, put call ratio jumps up 1.3 or higher, usually a pretty good signal, that we're bottoming. For tops, though,
it's harder.
It is. It's tough. And I've learned, especially over the last few months, when you're getting that top signal, but there's the Fed behind it, that's where that saying comes from, not to fight the Fed.
Don't fight the Fed, yep.
Right? Because we're still grinding.
All right. Do you have a couple favorite rules that you've kind of written over the years that you find really help you either keep your losses small or stay in those stocks that are going to go on those 20, 30, 40% runs? Yeah,
I think the biggest is probably taking partials at 20%, especially the later stage bases. I think it helps me to hold that core position for a much bigger gain. Last year was one of the first years that publicly, we had doubles in Pays and Roku, and there were several of those positions that taking the partial profits, right at that 20% mark, allowed me to just switch to the weekly, avoid the noise, and trust me, there was a lot of noise out there. But it helped me ride those to much bigger gains.
For sure, and that probably helps you psychologically as well to not worry so much about those really volatile stocks. I remember Pays was going up 5%, down 7%, up 10%. It was kind of crazy there.
Yeah, when you've pocketed a bit of that, you're in a much better position, to ride. Ideally, you always want to have that big position and ride that big position all the way. But, in reality, it doesn't always work out that way, at least for my personality. And I know that once I pocket it a little bit and can say, okay, I'm switching over to the weekly, I'm going to avoid the noise, I have a much better shot at getting those triple-digit gains.
Yeah, I experienced that a little bit with Space because I was up faster than I've ever experienced before, and I sold half at 20%. Then I just sold half today, but it's still going up. So I do find that because it's such a volatile stock, it's kind of settled my nerves a little bit, and my plan is to kind of ride out the rest of this position, and as long as the trend is up, I'll stay in it. But now that I've locked in those gains, it's helped me out a little bit.
Yeah, and I think as you do that more often, you'll kind of know going into your trade, or a lot of times you have a feeling going into your trade, at least with a lot of screen time. You'll find that, this is a good opportunity. My risk is tight. I can come in with a little more size in the beginning, knowing that I'm going to take a little off if I get a gain rather quickly. You can also tell by how fast the stock moves. I'm going to be a lot quicker on the trigger with a new IPO or something that with a much higher ATR, or something that's really moving wildly, versus something that's been slow and steady. So I think locking in those profits on the IPOs, on those ones that can move, double digits daily, I think it just helps, especially early in your career, to lock some in and learn those lessons without giving it all back. Very, very helpful.
For sure. So do you adjust your position size going into it based on ATR?
No, I adjust it more on how I've been running.
Okay.
If I'm running hot, the market's been good, I have a good feel for the stocks that I own are performing well, and I'm coming into something new, I'm much more likely to take a bigger position size. But I also have to look at the risk, and if I'm more inclined to take a bigger position if I'm taking something that's at the 50-day moving average, or I'm taking something coming off of a pocket pivot within a base where my support is just below, versus if I'm buying a breakout that's already up 3-4% from the breakout area because I missed it earlier, or it's something I've been watching. Here's a breakout. I'm much more likely to take a smaller size on that. So it's a combination of things, and then of course the character of the individual stock too. That will play a role as well. So if I'm in a large cap that's not going to hurt me and move quickly in the wrong direction, if I'm wrong, again, I'm much more likely to take a bigger size in that.
For sure. Do you have a favorite setup that you like to go to? Are you more of a breakout buyer, or are you more of a pullback to the 10-week type trader?
If you would have asked me this question a few years ago, I was a breakout buyer. Now I avoid them like the plague. I really try not to buy breakouts. I'm trying to either buy at support within the base, but when I see the volume coming in, when we talk about scans, I specifically set up the scans to kind of highlight those pocket pivots within the base, downtrend line breaks. Give me the light volume support pullback to the 50-day moving average. I'm much more inclined now to take those type of entries than the breakouts. Not that I don't. I'll still buy a breakout, and I'll especially buy a retest. If something breaks out on huge volume and I missed it, but then comes in on light volume, retest that area, I'm likely to still come in. But I try not to be that day of the breakout buyer anymore. It's just, I don't know, it's become more comfortable for me to buy elsewhere.
Interesting.
Again, that comes with time and experience and screen time, I believe.
For sure. So do you think the market's changed a little bit, or do you think it's more your approach that as you become more experienced, you're less inclined to take those breakouts?
I think it's a little bit of both. I think the market has changed. I think people are more aware of the breakouts. I think the big money often uses those breakouts or those big, jumps on earnings sometimes to sell into that to the retail crowd. I try not to be a part of that when I can. But at the same time, I think I've gotten more comfortable with buying below a base, within a base, buying the pullbacks. It's not for everybody. And I think that's a very individual trader thing. What's your character? What are you comfortable with? What feels right to you? And that may change over time. And when past 20 years into it, I think you know who you are a little bit more as a trader. And I definitely know that I'm more comfortable buying a pullback to the 50-day moving average. I'm more comfortable buying within a base than I ever would have been, in the beginning. I was always looking for breakout and volume. Just give me breakout and volume. As long as it's not 5% past the pivot, I'm going to jump in. But I think that, that's a little bit more of a dangerous game now because the retail, side of it's more aware of that and how we use that. And then the institutions are more aware of, okay, this is where I'm going to unload some.
For sure.
So it's changed.
Yeah, that's interesting. Seems like everything's been working recently, so I wonder how my approach will change as I kind of mature as a trader. So thank you for that insight. That's very helpful. So one of the main things I wanted to talk to you about was MarketSmith. So if you would mind, we could go to that and talk about your scans.
Sure. Probably the biggest one and the one that kind of guides me on the big picture stuff. Let me move this over. This is my focus list, and I love to see a red market and these top stocks that I have on the focus list all performing well today. That's a good sign that I'm on the right track. The leaders are acting well, at least what I consider the leaders. All of these have annual EPS growth 25% or higher, so they're strong earnings. Then I'll kind of go through them individually and say, okay, is there a new product or service? If you look through them, genomic testing, new. GSX, education over in China. You know why that one's getting a huge boost. In-home education. Shop is just a monster. Maybe Amazon Light, type of thing. So in Pod and DXCM, both of those, Dexcom and Insulet, those are ideas on the new way of reading blood sugars and delivering insulin. So these, all of these, DocuSign, another one, just growing by leaps and bounds. It said, when I closed my last mortgage, I never left home. DocuSign, I signed everything, from home. I didn't have to go anywhere. So anyway, this is kind of my big picture screen. And where most of my position trades, those big picture ideas will come from. So, and I own number one on there. I own Tandem, which is in this group with Dexcom and Insulet. I think it's a little further down. XP is another one that I really like.
Really good new IPO.
I've got a position in that one as well. What I like too, there's pins, Pinterest down there. Huya is another one that I've been in and out of for several years. Just can't seem to time that one right. But a lot of these are the big, growth stocks that we all know and talk about and want to get into.
For sure. So do you gauge the market health at all by the number of stocks that appear on your scans and on this focus list?
I do, but not just this focus list.
Okay.
I have another scan we'll go to as well that helps with which groups are hot on each. In fact, while we're talking about it, let's just go right over to that.
Sure.
So this is another one I share, this velocity scan. This will tell me on any individual day what's, really moving today. It's all going to be up 3% or more, and the volume run rate, the pace of volume is going to be 30% or higher above what's average volume. So we all know Virgin Galactic has been on fire, but you can see, today there's a nice mix. There's biotech in there. There's some software in there. There's genome in there. There's TDoc, Teledocs in there. It's a nice mix. So despite the averages, really, at least when I last checked, we're getting hit pretty good. There's plenty of opportunity here. It tells me, there's not a whole lot of fear going on when one of the hottest ones we've seen is up 24% on
it's been crazy space.
Yeah, you've got a couple others, up double digits in there as well. Lake Mason probably either earnings or news or something up 24%. But this, when I start seeing this get defensive, where we're looking at defensive names, or there's nothing. When you come over here and it's empty, nothing was up 3% or more on volume, those do help give me some clues that, hey, better be careful here, or, pay closer attention, to what some of the leaders are doing. But when I combine this with what I saw on that focus list, right now I'm not getting any signals that tell me to be overly concerned, with today's action.
For sure. And is 22 items kind of about normal for this list?
Yeah, I would say it's about average.
Okay.
To be honest, for a day, where, let me see kind of where we're at. For a
averages.
Day where the headline numbers are not good, this is actually pretty strong. Given that we're down 1%. I've had days where we're up, 0.5%, and there's only 5 or 6 names. That's cluing me into something, there, that there's a little more distribution going on under the hood. But I would say this is about average. On a really good day, I've had this 40, 50 stocks, 40, 50 names. And, those days, that market's really ripping, especially when you see these early in the session start popping up, and we've got 20 or 30 of them a half hour in. That's usually a good sign that we're going to have a strong session.
Great. So how does the power scan differ with the velocity scan?
Okay, so this is a daily scan. The power scan, that's going to be more relative strength based.
Okay.
So when I'm looking at these are all have the relative strength line into new highs. So these are going to be stocks that are really outperforming the S&P. And again, you've got a big list here, 84 names today of stocks that have their relative strength into new highs. This is also more of a multi-day or even multi-week scan. You see the relative strength ratings over here, are all 96, 95 and higher, 99, and I sort them by the relative strength rating, and then that the relative strength up down volume is another way that I'm sorting them, and then that the relative strength line is in new highs. You see that for all of them. So that's what tells me there's power, behind these moves. And I've told several followers, when you start to see these names pop up on multiple lists, try to find an entry because they're showing you everything you'd want to see. They're in top groups. They're showing strong relative strength versus the S&P. The growth is there, for future growth, or whether that's earnings or sales. I have both of those tied in, to that focus list. So a good way to keep the best stocks, front and center on my radar.
Yeah, I know when I see stocks appear on your list, on Brad's intraday list, on my fundamental list, those are the ones that I really focus on. And I think space, I think I found that actually because you mentioned it and also Brad mentioned it as well. And it's worked very well. So if a stock is showing that good relative strength and it's got something special going on for it. So yeah, I like that idea of focusing on those top stocks. Do you look at the percentage of funds at all, and do you take that into account?
I do. I have I do. I check out, exactly who's in. I don't think we're going to see much because there's only about 60 or so with space.
Mm-hmm.
But let me.
You could go to Flugin again.
What happened?
I was just suggesting you could go to FLGT as again.
Oh, okay. Yeah, let me come over here. So, you look at this number of funds,
Mm-hmm.
and the growth here, going from, just a year ago, 17 to now 71.
Mm-hmm.
But that's exactly what you want to see. You want to see that big growth. You want to know that those institutions are starting to come in, even though it's, low float stock and it's smaller. You're probably not going to have any of the bigger, well-known, institutions in there. But still, this is, a great start. When I'm doing my initial research, this is something I'll look at and make sure that those, fund ownership is growing.
Mm-hmm.
Like with SHOP, when you see this type of growth in institutions, a while back I was told that the turning point for a lot of the stocks is somewhere between 300 and 400. So when they make that transition of going from under 300 funds to then jumping into that 300 to 400 range, that's a lot of times when you see this type of growth follows. And whenever the number of funds and the ownership is climbing like this, you can always be sure, you're also going to see a chart, that looks like this.
For
because
sure.
You really can't go from, 700-800 funds to 1,100 or from 600 to 1,100, without seeing the stock really outperform. So yes, definitely another good thing to keep an eye on.
Great. Yeah, that's a lot of very interesting info, and I actually didn't know that about the funds, that you could just look at that in MarketSmith, so I'll definitely be using that, so thank you for that tip. Is there anything else you'd like to cover? I think you've given us a lot of great insights, and I know I've learned a lot, but is there any final things that you kind of want to go over?
Was just looking over some of, no, I think that's about, I have a Velocity 2 scan, and what that is basically the same as that daily Velocity scan.
Mm-hmm.
But I took out some of the parameters, fundamentals, that group strength, some of those things. I just took that out.
Mm-hmm.
And just went straight price and volume. This is something that I've been tinkering with, still toying with, but it's another one that gives you a great idea, of the overall market and kind of where we are from day to day.
Mm-hmm.
Stripping out some of those, basic composite rating and group strength and that I have in the other one. But
so this is what's working at the time.
Yeah, I'm constantly, I kind of got those other scans right where I want them, but I'm constantly tinkering with them, elsewhere to see if I can improve. And sometimes it's the market itself that will improve on that, and other times I realize it's not worth it. We're good with what we have. Stay with it. Yes, newer isn't always better.
Mm-hmm.
It's just newer.
Mm-hmm.
Sometimes that's been the case, and when that's the case, I'll stop. But I have found that Pinterest was one of those that wasn't coming up on the daily Velocity scan because it was so far down in price and beaten up and relative strength. So I said, you know what? I need to come up with a screen that will pick those up. So that's where I'm still working on this one. It's in progress, but just know that the learning, and that's the main thing I wanted to get with this, is the learning never stops. 5 years, 20 years, 30 years, doesn't matter how long you're in the market. You can always improve. There's always more to learn. It's pretty incredible, in that regard, that you just never stop learning.
Well, I'm going to start with those books that you recommended, so thank you very much for that.
Very good, very good. Yeah, I don't think you can go wrong with those. I think, those put you on the right track for sure. And just, you'll find. Did I come back up there?
Yep, you're right where you wanted.
Well, you'll find, that over time, you'll take all of these books, everything you've read, everything you've learned, your own experiences, and you'll develop your own process that fits your personality. This is who I am. I love this William O'Neill or Stan, rule, but this is my rule. That works better for me. And I think once you get to that point, that's when you realize, okay, yeah, I'm my own trader now. I don't trade like anyone else. I can see what everybody else is doing and maybe, develop my own process and my own ideas from them. But I'm really an individual trader at that point, and it's tremendous growth from there. You really learn a lot about yourself.
Well, great. I think that's the perfect place to end it. So thank you so much, Ben. You've given me a lot of good information, and I'm sure my viewers think that as well. Is there any kind of thing you'd like to plug? I myself would say that if you're not following Ben on Twitter, I highly recommend it. He's always helpful, always giving out good ideas. But yeah, it's off to you, Ben. Anything you'd like to say?
No, nothing to plug. I appreciate it. I have nothing to sell you. Come visit me on Twitter, Pattern Profits, or on the blog, patternprofits.net. More than happy to help. That's something I think FinTwit I've seen grow tremendously. Fantastic community there, tons to learn, lots of sharp people there. Come on over and hang out, and we all grow together.
Awesome. Well, I think that's it. Thank you so much for watching, everybody, and please remember that if you enjoyed this and found it helpful, to leave a like down below, and if you have any questions, leave it down in the comment section, and I'll be happy to address them. So thanks so much, guys, and I'll see you guys in future videos.